Welcome everyone once again to tonight's class. Like I said, tonight's class is continuation of where we stopped last week. Last week, we were looking at substantive procedures, and the introduction to the class was done by the other lecturer, and we looked at what is substantive procedure. Basically, substantive procedure are those audit procedures that the auditor will carry out to test and to get audit evidence on a matter, financial statement, transactions that have been made by management. They involve you testing for existence, testing for occurrence, testing the various classes of transaction, about the valuation. Basically, what you're doing is to try to discover or test whether there is any material misstatement in all the figures on the financial statement. So when we talk about substantive procedure, the auditor is focusing on the line item on the financial statement, and vis-a-vis the test of control, substantive procedures that will be carried out, analytical procedure, is to confirm and verify that those figures are correct, that they are accurate, and that this figure. Hello, is somebody talking? Please, if you are not, if you don't have a question or you're not talking, please let us mute so that we don't have distractions. And if you have any other thing, you can also drop in the comments so that I'll just get to. So we need to understand what substantive procedure is all about. That's what I'm trying to say. Now, just like I've said, the auditor at this stage is testing all the line item in the financial statement, trying to ascertain and verify the assertions that have been made by management. When we say financial statement assertion, they are the basis for which management has prepared all those line items you see in financial statement. Take, for instance, your PPE. There will probably be a value to the PPE. PPE will be broken down into land and building, your plant and machineries, your other current asset, inventory. There will be inventory figures, there will be non-current assets as well, there will be receivables, there will be prepayment. There is also your liability, payables, non-current liability too, and all of those line items. The management will have done their own management account, put a figure to it, and prepare a draft financial statement. Now, the auditor is trying to verify that those figures, those values for those line items, whether it's in your statement of financial position, whether it's in the income statement, whether it's in the changes in equity, that those figures are right. And that's what substantive procedure entails. Testing that those figures, and the auditor is testing for accuracy, is testing for completeness, is testing for existence, and is testing for valuation. So that's what substantive procedure is all about. Now, there are some other procedures or activities that entail substantive procedures. That is the way the auditor will go about testing for this. The auditor can use your analytical procedures. Now, when we say analytical procedure, what we are invariably saying is a comparison between prior financial statement and trying to justify that the changes or the movement in the financial statement makes sense. Take, for instance, if the gross profit margin for a certain client over the years has been 20%. Now, looking at the current financial statement, we expect that even if there will be a growth in the gross profit margin, it should be within reasonable limit. Now, if there is any unusual increase or decrease, these are areas the auditor wants to find out what is happening. Why do you have your gross profit jumping from 20% to, let's say, 50%? There must be valid reason for all of this. Is it that there is an injection of fund? Is it that equity grew? Was there a facility taken? Now, these are all substantive procedure. And last week, the other lecturer will have talked about non-current asset and all of that. So last week, we looked at inventory. Now, we said that inventory is very, very important in financial statement, in even any companies that is involved in inventory, whether, except for service-oriented business that don't really have inventory. But once you are a business or an entity that has inventory, inventory is an area where people can play around. There is risk of using inventory to manipulate figures to boost profit that is not there. So there are some principal risks that are associated with inventory. We looked at all of that last week, and we also look at inventory count. Why is it important that there should be appropriate count, the true value of inventory, and how it should be done, what the auditor should look for, what are those risks the auditor should look for, how should the count be done to justify the count value. Then we also look at valuation of inventory. Now, everybody knows that inventory should be valued at lower of cost on and net realizable value. Now, how has the management been valuing inventory? What are those? Is it in line with standard? So we looked at all of that. From inventory, we look at receivables, how is there a proper justification for the receivable? What are the receivable mechanism, irrecoverable receivables? We looked at all of that last week, and I will advise that you go over those texts again. Look at the major thing you should focus on when you are looking at substantive procedure is that take a line item, look at the principal risks that are associated with that line item. When we say principal risk of misstatement, where is it that management can usually fall into error or omission, or there is a where is it that this line item can be manipulated? What are those risks that can cause errors or fraud around this line item? That's what we mean by principal risk of material misstatement. So when you are asked in an exam to write about what substantive procedure you should carry out for inventory, first discuss the principal risk that are associated with inventory. Then you can now go to the procedures, what the auditors should do to test for all of that. So that's all that we looked at last week. We looked at inventory, receivable. We also look at bank and cash balances. Under your receivable, we look at secularization. How do you get confirmation of the receivables from the customer? What and what should you do? We talked about the two types of confirmation: positive confirmation, negative confirmation, and which one is ideal. So those are all the things that we've been looking at, and today we will continue. Now, any questions so far before we go on? Any questions so far? If there is none, then I can start this class. So today we are looking at inventories. We've looked at, I said we are looking at substantive procedure, please. We've looked at asset. We've looked at current asset. I believe the other lecturer should have taken you guys on non-current asset. So today we are looking at other areas of the financial statement, and we'll be focusing on trade payables. We'll start with payables. These are liabilities. We'll look at payables. We look at what are those things that are the risk, the principal risk of misstatement around payables. We'll look at the substantive procedures that the auditor should carry for trade payables. Then from payables, we'll look at accrual. So we are now looking at the liability side of the financial statement. We look at accruals, we look at provisions, we look at contingency. What are those principal risks of material misstatement that are associated with accruals? What are the substantive procedures that the auditor should carry out to verify the accruals? The same thing for your provision, your contingent liabilities. We looked at the standard on contingent liabilities. We look at what is the definitions. Then we also look at the substantive procedures to carry out for contingent liabilities. And from there, we also look at non-current liabilities because we are looking at liability today. We'll look at what are non-current liabilities, what are the substantive procedures that should be carried out for non-current liabilities. Then from there, we'll now look at income statement. We'll look at your revenue, purchases, and how should the auditor test for material misstatement around income statement. So basically, this is what we'll be looking at today. So not to waste most of our time, let's start. Now, if I may ask, because I like to ask questions, which makes the class interactive enough. How many of us understand what we mean when we say payables? Anybody? You can tell me what you understand by pay. This is it's like accounting 101. But anybody, quickly?
Okay. I believe the payables are the things that you owe, like the company owes.
Okay. So payables are the things the company owns. What is different between, if you say payables are the things that company owns, what's different between the payables that you owe? I want to talk, how about loan? When you collect loan and you know you have to pay back, is that payables?
I
Like
would,
bank loan.
I
Let me
would,
ask,
I would, I would say so.
payable is a liability from what you just said, that what you owe. Now, but is it the same thing as when you owe money to a bank, or you owe and somebody a loan note, or a government has given you a grant that is expect and aid that you expect to pay back? Are they the same thing?
No, they are different.
So okay, what?
Payable is the result of maybe exchange of probably goods or services,
Yeah,
but loans is just basically maybe, yeah, loan is loan. So payables is as a sort of exchange of goods or services that you are owing
okay,
to pay.
that's a good one. So when we talk about payables, we're not just talking about what you owe, because you can, all of this, we are looking at liabilities, audit of liabilities. So when you collect loan, that's a liability. When you make provision for something that you know will happen, there will be a probable liability in the future, that's a liability. And when you sell, when you receive goods from supplier and you are yet to pay, that's also a liability. So trade payables are those things that you receive goods from, and you are still yet to pay for it. It could be service, it could be good. For instance, you have electricity that you incur and you pay maybe later, or you receive good, you are yet to pay. So payables are usually current liabilities. You have to settle them within 12 months limit. Once it's more than 12 months, it becomes non-current liability. So now that's what payable is all about. So based on that, before we go into looking at trade payables, let's just talk generally about liabilities. Now, liabilities are what you owe people, what you owe your supply, what you owe banks, what you even owe maybe government, and all of that. Now, what we are talking about is how auditor test for the values in the financial statement. Last week, when we were talking about inventory, with then PP and all of that, those are assets. So when auditors want to test for asset, there are different things that is at the back of the mind of the auditor in testing for asset. There's what we call financial statement assertion. That's the basis for preparing the values and the figures in the line item. So when management are preparing asset, there is the risk that management might overstate their asset. Why? Because when you overstate your asset, it shows that you have enough things to make your production or your operation effective. So the risk is that most people want to overstate their asset. So even when they don't have the asset, there is tendency to say, we have a plant, we have a factory, and we have money that people are owing us. People have tendency to overstate their asset. And that's why when auditors are testing or carrying a substantive procedure on asset, the focus is usually on overstatement. They want to be sure that the client is not claiming than what they hold, what they have rather. So in inventory last week, when we were talking about inventory count, you want to be sure that the inventory the client is claiming in their book is actually their inventory. So you want to also test for existence, that those assets exist. So that's the testing direction in testing for asset. But when we're talking about liability, because liabilities are those things you owe people, you owe supplier, you owe bank, you even owe, maybe there are some people that are giving debenture loans, or some people that have invested in the business that are expecting repayment back, even part of their shareholders fund can be seen as liability. Now, because these are things that you owe people and you expect to pay them back, and anytime you have liability, it will also eat into your equity, eat into your asset. So there is a tendency that clients will not want to state all their liability. So when auditors are testing liability, the direction is usually to test for understatement, that they are not declaring all they owe, because once your liability has a way of eating into your profit. So, for instance, if you claim you have 100 million as profit and your liability to settle and all of that is up to like 50 million, 80 million, that means the profit will reduce in the long run. So people don't want to state their true liability. So the testing direction for auditor is to look for understatement, to be sure that there is completeness, that everything that the client or the entity is owing has been stated. So the focus of the substantive procedure in liability is testing for understatement. So when we now come to trade payables, based on that understanding that client might not want to declare all they owe. So how do you go about carrying out substantive procedures for trade payables? Now, like I said, we all know what payables are. Payables are very material in the statement of financial position of entity. That means payable play a significant role. Just like your receivables, you know, receivables are money you are expecting from customer. A client has supplied customer, there is a dealership, there is whatever you've rendered services, and the customer are owing you money. Now that's an asset because you're expecting the money to come in at the point in time. So the same thing on the other side, you are now the client. You've received goods, you've received raw materials, you've received services from parties and entities. You are expected to pay back. So the same way is that the same way the auditor will be testing and confirming from customer whether they are actually owing you. So the auditor at this point in time also needs to confirm from supplier whether you are owing them. Now, it's very difficult in testing for liability because the risk is that they are not declaring everything in the book. So the customer has to be, and the auditor has to be attentive, to be careful and have what we call inquisitive mind, which is professional skepticism, looking beyond the books to detect, have they declared all they are owing? Okay, you are running a business, you have inventory of this value. Okay, have you paid for all this inventory? Or if you say this is your production, your cost of sales and all of that, and these are your purchases, where are the evidence that this is matching? So the auditors must be inquisitive and have a critical mind, because you want to be sure that these are actually the values of the payable. So there is an indirect confirmation, a direct confirmation rather from supplier, though this is not the practice, because you can't be asking, you need to get evidence that they are even owing first before you start secularizing supplier. So payables, they just keep it at the back of your mind that the auditor is testing for understatement. The auditor also is testing for what we call cutoff. One of the assertions or the basis of financial statement for all the line item is that everything that is recorded in the financial statement is recorded in the appropriate period. So there is no carryover of the last period and there is no recording of a future date. So take for instance, your payables, you're supposed to pay within 12 months. So you are not recording something that is already like forming into a non-current liability. So maybe you won't be paying back until a longer period. You want to be sure that there is an appropriate cutoff for the payment. So the work will be around purchases. You try to verify purchases. You look at the bank account, cash statement. You look at the history. You look at the inventory, just to justify that this payables that is in the book is actually correctly stated. There is correctness. There is completeness in the stating of the payables. Is anybody asking question? Hello, I can't hear you. Please, if you can raise up your hand using the what's it called, the icon, so that I can also be aware if you're asking question. But if you're not asking question, please let's just mute so that we don't distract. Okay, so that's for trade payables. Now, what are those procedures that the auditors will carry out when testing for payables? What are these procedures? That's what are those steps or those things that the auditor should do to test for accuracy? I've said that the focus is on completeness, not on, you are looking at the fact that there might be understatement. So you want to be sure that there is full disclosure. So the first thing the auditor will do, the first substantive procedure or the procedure it will carry out is to obtain a list of balances on suppliers account in the payable ledger. So you get the payable ledgers and you ask the client, oh, you're auditing a certain client. Please provide us with the details of all the listing of your suppliers account. You want to see all the suppliers account. So when you get the list of all the suppliers account, you will be of the trade payables, you'll be looking at the payable ledgers. Okay, supplier A, I supply this. Are you owing? You check first all of that. Now, if you obtain the list from the client, one thing you want to check for is arithmetic accuracy, that there is the list are matching. Oh, if we know that this supplier supply 1,000 units of maybe raw material at a certain cost, does it match? Or this supplier supply us from January to date and we'll be paying, maybe we pay every month. When you calculate the unit supply, the outstanding amount, they must be accurate arithmetically. So you want to check for the computations of the payable for accuracy. You want to check the balance for accuracy. Now you can do a random sampling, take some samples from it, then you can now confirm from the supplier themselves that, oh, this you do supply every month. How often do you supply? How often were you paid? By that way, you can check that there is completeness and the valuation is correct. So you take a random sampling, you can use any sampling method based on the supplier's account, the way the supplier supply. What you're doing here, you're testing for accuracy and you're testing for completeness, that the value is correctly computed and that all payables have been recorded completely. You check that the value agree with the balance. So based on this, the auditor will do that. Now, when you are doing sampling, it's not necessarily that you test all payables account. Just look for a reasonable number. Look for account that probably are lower or account that are big. You have a different parameters. You know, some in the payable ledger, you can have some that they will say, we are not owing certain supplier, 0 naira. You can do declaration to confirm, is the client actually owing you or not? And you see some that say, we are owing big money. You just take random suppliers account to verify the balance. And once you note any discrepancy or you note any misstatement, that's the area you will now focus. Use that to escalate and look at all other suppliers account. So basically, these are substantive procedures you carry out for trade payable. Number one, you should obtain a listing of all suppliers account. Number two, check the list for arithmetic accuracy. Number three, rather, take from the list, check that it matches, the account matches. Oh, based on the unit supply, you're checking for completeness. Then take a sampling of any of the suppliers account to verify from the supplier. Look at numbers that are just select using look at the balances. When you see zero balance or you see which figure, just check and confirm from the supplier that these are correct. So like I said, what you are looking out for here is understatement, the risk that the client will not state all that they are owing. So the risk that they will not state all they are owing. Now, there could be a client system that has high T, or you can use all this software to do your sampling method. Now, there are all this software that will help you in doing the appropriate samplings and testing for all of this. So that can be used. So basically, when you are in the exam, like I've always said, the audit exam is not going to be what is payable, what do you test for payable, list the substantive procedure for payable. The audit exam is usually like a case study. A scenario will be painted for you that, oh, you are the auditor for so and so, and you are carrying out the annual audit. And in the course of carrying out the annual audit, you notice that some suppliers that can't have outrageous amount, and you notice that some suppliers have not been paid for a certain period. As an auditor, what substantive procedure should you do to verify and confirm that uh, your your whatever is true? So the question will just come in a case study or case scenario stuff. What they're actually asking you is that how do you apply what we are talking now? So if once you see that the statement is bordering on you are owing a certain client, a customer, then you know that they're asking you for liability. Somebody has dropped a question in the group. Let me check and see. Okay. Good evening, sir. I can't hear you. Could it be network? Oh, sorry. Please confirm if others, please confirm if you can hear me clearly. And if you can hear me now, please let me know. The network has been funny lately, but
I can hear you, sir.
okay, thank you. Thank you. So you can check your network at your hand if it's breaking or it's not strong. I understand network these days can be funny. So like that's for payables. Now today we said we are looking at liabilities, substantive procedure for liability. And if you take your liability section of the financial statement, we have payables as one of the liability there. We also have accruals and that's what we want to look at now. So let me ask, just like I started at the beginning, now what is trade payable? Can anybody tell us what we mean by accruals? Forget what is reading in the text. Use your own word. Let me know whether we understand what we mean by accruals. Anybody wants to try? Hello, is anybody trying? Explain to me what you understand by accruals. Is anybody trying? Okay. Anyway, if nobody is trying, I believe we all understand what accruals are. Now, accruals are more like your prepayment. Last week, we talked briefly on prepayment, and I expect that you guys should read. You know, prepayments are like you are paying in advance for a service or for goods yet to be received. Take, for instance, you are a client and you have a building that you use for your office and you pay the rent in advance. So at the beginning of the year, you are paying rent to like December, the end of the year. So you've paid your rent up to December. Now, when you are preparing your monthly management account, that rent will be captured as prepayment monthly because you've not used the future month. So as you use it, that's you have a place that will capture all the other months as prepayment, meaning that you have paid for the service yet to enjoy. So you paid in advance. That's prepayment. So if anything happens, maybe you have to leave the building. If there is a proper agreement with the landlord can, maybe you can get back your money, or you've paid for goods. You are into you do run a warehouse or you sell retail. You pay in advance for some goods that you are expecting. So this time around, you are not owing, and somebody has not you are not supplying good, but people are supposed to supply good to you. So in your book is prepayment. Now those people that you've paid that they are yet to supply you, in their own book is a different treatment. So accruals are usually estimated amount which will be subject to audit techniques. So the same way you calculate prepayment for future, for instance, let's say you pay 100,000 for 12 months, or you pay 100,000 for 12 months. When you pay to December and you are preparing management accounts at July, the money from July to December will be captured as prepayment. Will be captured as prepayment. Now, that is clear enough, but accruals is a bit different in the sense that accrual are more like estimate amount. Because you are not sure of the amount you've incurred, but you are calculating it based on estimate. It's more like, how will I describe it so that you guys can understand better? Now, these are foundation accounting, but I just want you guys to understand what we mean by accrual. Now, accrual is that when you've incurred the transaction, but the payment will be taken, is like for 12 months. Now, let's say I'm looking at the best way to let you guys understand this. Let me explain provisions, then I'll be able to explain the accrual. Now, provisions. When we talk about, because we look at accruals, provisions, and contingents all as one. We look at the treatment as one. So, for provisions, you make money for something that you know will be a liability to you. Take, for instance, you are involved in a court case. The client is involved in a court case. There is a court proceeding going against the client. And from the advice of your lawyer, you know that you guys will not win this case. So there will be a judgment against the client and a certain money will be awarded against the client. Now, the thing, according to standard, is that you make a certain money available for that judgment. Now, because you don't know the exact amount that will be awarded against you, you just, based on expert advice and knowledge, you make a certain provision, a certain money. That's provision. Now, it could also be you have a warranty service, that if you buy our product and if you come back in the next 6 months for any issues, that we will repay, we will refund. Now, you don't know how many of your customer will come back for to claim that warranty. So in your books, you will make provision for it. Now, that is how provision works. Now, for accrual, it's more like the same way, but like you are owing people, they are rendering service to you, you have to pay them. Let's take wages and salary. That's another way I can explain accrual. Now, you have people working for you, and you've signed agreement that you'll be paying them month end, or you'll be paying them every week. So they're already in that contract. Now, the moment you sign that contract, you're already owing them. That's why people will say, at the end of the month, I'll get my salary. Now, you have to make provisions, keep that money. So as every month comes, you are incurring that amount month in, month out. So you must, it's accruing to you. So liabilities such as accrual, provisions, contingent, liability, they are usually estimated. Take, for instance, you make provisions for accrued wages that you pay people at the end of the week. Now, you've had that money. But let's say something happened, one of the clients resigned, or somebody just, the agreement didn't go through, means that money that you provided for will not be a surplus. The same thing with provision. You are saying 50 million, you provide 50 million for a court judgment against you, and all of a sudden the judgment was 30 million. So there is 20 million shortage, excess. It could be more or could be less. Now, what that creates for the auditor is that any area of estimate, whether it's on liability or it's on asset, is an area where there can be risk of misstatement. Because one of the things that makes some people will say financial statement profit is paper profit is because there are elements of estimate around some figures in the financial statement. Take, for instance, your depreciation. If you are using reducing balance, you are estimating that or you're using standard line method, whatever, that this asset will be depreciated in 5% rate. So you are calculating based on estimate. Now, that calculation, because there is a bit of estimate around it, it might not be the actual thing that is happening in reality. So that's why anytime you have estimate, the auditor wants to be careful that there is no overstating of the estimate or understating of the estimate. So these areas are very, very subjective. And that's why auditors, they just look at this area and be sure that there is no manipulation around it. There is no a bogus claim by the client. So we want to check that accounting policies have been appropriately applied, that there is completeness, there is justification for those provisions. So that's what we'll be looking at. Now, what are the risks, like I said, around accruals, contingent liability? The risk is that because these are subjective area, it means that the auditors want to see, first and foremost, are these materials, the accrual I'm looking at, the contingents I'm looking at, the provision, are they material? What is the materiality involved around this figure? Every audit comes with materiality. There must be a materiality threshold. So the first thing the auditor wants to check is that, okay, are these things material? If they are material, then it will now start the substantive procedures. Get a listing of all those liabilities. What are the book of accounts that you have? How many provisions have you made? Take, for instance, bad loans. You have provision by bad loan. And the auditor wants to check that what you are doing is in line with standard. Take, for instance, provision. The IAS 37 that say this and these are what provisions should look like. These and these are what is constitute provisions, because it's not every liability that is provisions. There is have the management follow through on those standards. And that's why I said at the beginning of this class, what the auditor is testing when it comes to substantive procedure is material misstatement around the financial statement assertions that have been made by management. That management, are they justified in the way they've arrived at the values for all these line items? So whether it's provision, whether it's liability, whether it's asset, what the auditor is looking at is the justification for those figures. So it's testing that these figures, do they make sense? Are they in line with accounting policy? What does the standard says around this? Take, for instance, provision. IAS 37 has definition of provisions. Does the management definition for this meet what the standard says? When it comes to provision, how do you provide? What are those things? Those management basis is in line with standard. So the auditor will also be testing for that. Then the measurement, how have they come about the figure? That's why, please, if you have time, which I believe you should, go back and read that introduction to substantive testing. And under that introduction, we made mention of financial statement assertion. I want you guys to read that part very well, because most students usually, when you ask what are financial statement assertion, they get confused, they don't understand. Please, I'm giving it as an assignment. I'll put it on the WhatsApp group. Go and read that financial statement assertion. Understand what and what constitutes financial statement assertion. And when you test for different one, when is an asset, what are you testing for? When is a transaction, what are you testing for? So that's one assignment. Please, before we finish the class, somebody should remind me that I'm dropping it on the WhatsApp group. Financial statement assertion, go and read it again. So based on all of that, the auditor wants to be assured that management have basis for making this provision. Management have basis, that the management has not overstate or understate their provisions, that the definition of provision has been covered by management. Now, what are the substantive procedures that the auditor should carry out for provision? For provision, anytime there is a provision in the book, what should the management and the auditor test for? Number one, when it comes to provision, the key substantive procedures that the auditor should test for is that the auditor should first obtain a list of all the provisions that the auditor and the client has made in his financial statement. And I want you to take a note. If you look at this substantive procedure, when we are talking about trade payables, we are talking about last week receivables, we are talking about prepayment, we are talking about bank and cash balance. The first procedure is always obtaining a list of that line item. So if you don't remember anything when it comes to substantive procedures, just know that the starting point is obtaining the list of all those line items. If it's a receivable, obtain all the receivable account. If it's payables, obtain a list of all the payables account. Now we're talking about provision. Obtain a list of all provision that the client has included in the draft financial statement. Now, when you obtain this list, what do you want to do with it? Because we are looking at, hello, is anybody? Hello, please mute your mic. We need to be, if you are in this class, be in this class. If you have questions, like I said, drop it on the chat. I will see and we'll answer it. It's not good that we'll be distracting others. So, substantive procedure, like I was saying, the first procedure is that obtain a listing of the provisions that have been made in the financial statement. Now, based on the listing that you are obtained, the list rather, you now want to check that the provisions for that have been made by the client are in line with standard. Does this provision meet the definition of accounting standard? IAS 37 is that covers provision. What management has done in this financial statement, is it in line with what the standard says? Does it meet the definition of provision? So you review that. If it's trade payable, like we said, hello, Augustine, please mute your mic if you're not asking question. Okay, so you want to be sure that the definition of provision by client meets what the standard says. Then you also want, the auditor wants to review the changes in the provision for the period. So you've obtained the list.
Sorry,
You've
sir.
checked. Yes, hello?
Sorry, sir. You said to review what?
I said the first thing is obtain a listing of the provision that the client has made in the financial statement. Check that the definition of provision based on standard is met by the client. So what the client is calling provision in their book, does it meet the standard definition of provision based on IAS 37? Then the third thing, you want to review the changes in the provision for the period. Now, what do we mean by reviewing changes in this provision? I've used the example of a court case. Let's use the example of warranty. Now, if a product, a client has a product that has 6 months warranty, and they made a provision for 1,000 units of the product. Okay, we are selling 1,000 to customer, and we've put warranty on it. There should be a provision for that 1,000 that should, in case all of the 1,000 people, they are coming back, that we have issues, we want to claim the warranty, the client should be able to meet their warranty. Now, they've sold some of this product, maybe the warranty is for 3 months, 6 months. They've sold some of this product for the last 3 months, the last 6 months. Now, it means that as the year progresses, as the month after month continue, there should be a review of the provision. You can't say in January, when you sold 1,000 units with probably 3 months or 6 months provision. Now, you sold 1,000 in January, 500 in February. Now, they all have three months. It means that for the 1,000, by the time it's getting to the end of March, there should be a review. Based on the new product you also are selling, there should be constant review of the provision. The same thing for a court case. If you have court case that is ongoing and is is maybe you have 2, 3 court cases. You've made provision for all the 3 court cases. By the time there is a judgment passing, you should be reviewing the provision. That's what we're saying. So the auditor wants to check that there are adequate changes in the provision for the period, that they are not carrying provision of last year into this year, or provision of last 4 months into this new month. So the auditor will be reviewing the changes. Actually, management will be making these changes. Oh, we have reviewed the changes, but the auditor is checking that those reviews are correct. And that's why I said that as this assignment, please, you guys should take this assignment very serious. Financial statement assertion is an area that a lot of students don't really get. Go and read what we mean by financial statement assertions. Now, why is it very important? Because when you understand financial statement, you understand what the auditor wants to test for. So for provision, the auditor is testing that there is accuracy, there is correct valuation of the provision. Now, the auditor will also review the measurement of the closing balance for each of the provision. If there are changes in the provision, it means that at the end of a period, at the end of the month, the closing balance of the provision should justify the current state. You can't say the provision, even if it's bad loan. If, for instance, you are auditing a financial institution or a credit institution, all those companies that give loan, there are, based on regulation and based on standard, there are provisions that should be made for bad loans. So over time, the management needs to review their provision for loan. It's called loan loss provision. So the loan loss provision should be reviewed accordingly. Based on the timing of the loan, there are different provisions you will make for different stages of the loan, of the bad loan. So the closing balance of the provision will also be reviewed by the auditor, and the auditor should discuss where appropriate. Why are you still carrying this certain closing balance in your provision? Why have you not reviewed this? So the auditor is checking for that. We said the first thing, the auditor will obtain a list of all provision. The second thing, the auditor will check that the definition of provision has been met and is in line with standard. The third thing, the auditor will review the changes in the provision for the period. The fourth thing, the auditor will review the closing balance of the provision and discuss any changes or why management think that the closing balance is appropriate. Then the fifth thing, the auditor wants to check that there is no omission of any provision that should be made. We talked about bad loans. There are certain provisions you should make for different ages of loan. This loan is 30 days, this loan is 60 days, this loan is 70 days. There are different percentage of provisions that should be made for that loan. Now, the auditor wants to be sure that there is no omission. That's why the auditor, when you understand the business you are auditing, you will understand the appropriate provisions that should be made, and you are looking at that there is no omission. I said at the beginning that when you are auditing liability, the risk is that there is understatement. So it's either management is not making appropriate provisions for some of these things. So the auditor wants to check that there is no omission. Then the auditor also wants to compare, which is the last thing, compare the provisions of last year with this current year. Now, why is he doing that? That's what we call analytical procedure. Last year financial statement, your total provision was 100 million, and your gross profit or your ratio analysis were around this rate. Now, this year, nothing significant has happened. Why has your provision suddenly increased to 500 million? So the auditor wants to check that there is possible relationship from prior year to this current year. So the auditor is, and that's one of the ways to test whether there is material misstatement. Analytical procedure is checking prior year period or comparative relationship. It might not just be prior financial statement of the client. It might even be industry standard. As a financial institution, you're supposed to make certain provision based on regulation. Why is your own different? Or you benchmark with competitors. You're a company of this type, this is your net asset, this is what you do. Why are you making different or your rates and your figures are different for what is obtainable in the market. So these are the substantive procedures that the auditors will carry out for provisions. Any questions so far before we go on? Any questions so far before we go on? Now, if there are none, I've given you guys one assignment. That's read about financial statement assertions. Read about financial statement assertion, the different types, and when you use them, what the auditors need to test. So that's one. Now, I'm giving second assignment. Today is an assignment day. I want you guys to go and read about the substantive. What are contingency liability? I want you to go and read about contingent liability, contingent asset, to contingent liability, contingent asset. That's the second. Read about the difference between the two. When we say contingency liability, what do we mean? When we say contingent asset, what do we mean? Now, are they the same? What are the difference between the two? That's 2A, the assignment 2A. Now, for 2B, I want you to go and read about the substantive procedure that you will carry out for contingencies, whether it's contingent liability or contingent asset. What are those substantive procedures you carry out as an auditor? You can use the text before you. You can check ICAN Pack. You can check any other material. But I want you guys to go and read about that. Now, any question before we go on?
Yes, sir. Yes, sir. I
Okay.
just want to confirm what you said
I can't hear
regarding.
you.
Can you hear me, sir?
Okay, I can hear you now.
Okay, so I'm sorry to take us back. I just want to confirm what you said regarding the prepayment and accrual. I know that's way back foundation.
Okay, so
lecture.
prepayment was last week. Now, what we discussed about prepayment is that you've paid money in advance for a service or good you are yet to receive. So, take for instance, you are in a rented apartment, you are using rented apartment for your business, but you pay in advance, you pay yearly in advance. So at January, your payment covers from January to December. Now, every month you will be netting off your prepayment. So you have money outside and you are yet to receive the service. It could also be for goods. You want to get raw material from supplier, or you've made money in advance. You paid money in advance. The other one, payables. Payable is like you've received the good, you are owing the client. So there is an agreement between two of you that you will be paying after 30 days for the goods, or you'll be paying in the next 2 months. But for prepayment, Augustine, please, can you mute your mic? But for prepayment,
No, sir. To understand the prepayment, but so on the other end, maybe like the supplier. So as the money, so that's the accrual that is accruing.
Yes. Okay. Please, Augustine, you need to mute your mic. You're causing distraction in the class, please. Okay. So don't forget I've given assignment. The first one is please read about financial statement assertion, the different types of financial. Please mute your mic. Who is the admin, the host for this class? Okay, now quickly, because we need to finish this class by 9:30. Let's see. Okay. We need to finish some. Okay, so quickly let's look at non-current asset. Non-current asset. Now, what do we mean by non-current asset? Can somebody quickly explain non-current asset?
They are assets that are kept for use for the purpose of maybe production or that generate economic benefits to the system, and it's usually more than one to the entity. It's usually more than 1 year.
Okay, that's fine. It means these are what you use in running the business, but the repayment or you most time is over a year. So non-current assets ranges from your loan from the bank, money that you've collected from maybe some people that invested in the business and you have to pay them back. These are all non-current assets. Now, there are also liability. They are what? Liabilities. So non-current assets are liabilities and they are also to be paid back. Am I right? Now, the same way you have a substantive procedure for all others, you also have substantive procedure for non-current asset. The auditor also want to test that your non-current asset does not contain material misstatement, that your non-current asset figure is in line, that you are not overstating or understating your non-current asset. So the auditor wants to test for accuracy, wants to test for the fact that you've recorded all the non-current assets the way it should be recorded. There is no overstatement or understatement and all of that. So the procedure is similar to all that we've been carrying or we've been discussing for all the other liability. The first is to obtain a list of all borrowing. So you obtain the list of all current, non-current assets. You want to be sure that there is completeness. So you get the listing from the client. You also want to be sure that the list is accurate. So you are testing that the closing balance is correct, that the amount is appropriately reducing as it should, meaning that the repayment is being calculated accurately. You also want to check on the opening balance and the closing balance. You want to check for any new borrowing. You want to check the loan agreement. What does the loan agreement say? Are you to pay after 6 months? Is there the documentation? Is there a special clause around the loan? So the auditor wants to check for all of this. So it's pretty simple like the other one. Obtain the listing, check that the list is accurate, check that the opening balance and the closing balance are correct, and check for the loan agreement, the loan clause, and the details of the loan being followed by the client, and check whether there is any restriction in the loan agreement. You know, there are some non-current, some loan from the bank that, oh, if you have this loan, you can't collect this loan, some grant, some loan from some investors or debenture that, oh, if you have this loan is given for the purpose of this business. There are some special loan that is for some special industry. So is the client following the lettering and the wording of the loans? These are some of the things you want to check for when you are carrying out substantive procedures for non-current asset. So in an exam, when you see the question talking about the client has collected loan, blah, 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 the client is owing this, what should the auditors do what audit procedure should be carried out to test that there is no material misstatement? This is what the examiner is looking for. Obtaining a list of all the loans. The listing should include all the loans in the business, all the borrowings. You want to check for the accuracy of the loan, the calculation, the repayment. You want to check that the opening balance and the closing balance figure are right. Then you also want to verify the loan agreement and documentation. Is it appropriate? Is the client in line? You also want to check that there is no restriction or clause in the loan agreement. So basically, the takeaway from all of this substantive procedure is that identify the risk that are possible with the line item, check for the financial statement assertion. Here you are checking for accuracy. Under the financial statement assertion, one assertion is what we call completeness accuracy. So you are checking for accuracy of the loan agreement. You are checking for valuation. So once you understand that, you can then write about the substantive procedure. Now, quickly, we have the audit of equity. Now, and this is the last part of the class for today. Now, if you look at your equity has the shareholders fund. You have your shareholders fund, you have your retained earning, you have your reserve, the share capital, you have directors, enrollment, you have all those capital investment in the business to run the business. Now, just like for your liability and your assets, you do carry out substantive procedure for the equity too. Now, what the auditor is doing here is to verify that the equity value is correct, that the equity value is appropriately captured, that there is no overstatement of the equity value. People want to put up that, we have money, we have capital in this business. The auditor wants to test for the fact that, and in the accounting equation, your asset minus your liability must give you your equity value. So the auditor also wants to test that the total net asset and the total liability must equate your equity. So the auditor wants to see that the total value of your equity match up with your asset and your liability when the accounting equation is done. So the auditor will carry out substantive procedure around your share capital. It will carry out substantive procedure for your reserve and all of that. Now, under your equity, you have different way of verifying your equity value apart from what the management has put in the draft financial statement. You want to see the board of minutes, you want to see the number of shareholders, you want to see whether the share, what is the share value, the capital of the company. So you'll be asking for the company's document. You'll be asking for the register of the company document. In every of the CAC, there will be a declaration of the shares of the company, the value of the shares, if there are changes. So to test for the equity, you don't just rely on the financial statement figure. You go back and get the company's documentation where it was stated that this is the asset of the company, these are the shareholders, this is the value owned by all of them. So you want to check statutory books, those books that have been submitted with the regulatory bodies that captures the net asset of the company. You want to verify that against what is reported in the financial statement. So these are the areas of focus you obtain. And if there are also changes in the equity, you want to check that. You want to check how are these changes captured? What are the supporting documents to back the changes? Have the legal requirement been complied with? If dividends have been paid, you also want to confirm that the dividends have been appropriately calculated and distributed appropriately. You also want to check for approval for dividend payment. You want to check how have they been calculated. So just have your head around this, because in the exam, like I said, these kind of questions will also not come direct, but you must understand what the examiner is asking. Maybe by next week, if I'm taking you, I'll bring past questions just to check how questions around this area are being set. Now, quickly, we'll be looking at income statement figures. Now, under your income statement, there are two areas that the auditors want to focus on: your revenue and your purchases. He wants to focus on your revenue. He wants to focus on all the other areas of the income statement, quite all right. But he also wants to test your revenue and your purchases as well as your expenses. Why is it important that the auditor should focus on the revenue? Now, this is where the auditor can determine if there is a material misstatement of overstatement. Now, just like we're looking at the asset, that people want to overstate their asset and their liability, they want to understate it. When it comes to the income statement, most clients wants to overstate their revenue. Oh, we are making this much money. So there is the risk that overstatement will be around the revenue. So the auditor is concerned about testing for overstatement. Now, under the income statement, when you look at the expenses, the risk that will exist for expenses is that client wants to understate their expenses. And if you might ask yourself why, the reason is that when you understate your expenses and overstate your revenue, you can claim bogus profit. Oh, we are making profit. oh, our profit is this big. So the auditor wants to focus this testing around overstatement around revenue and understatement around expenses. Now, the auditor will be vouching for transactions. Oh, you've made this much revenue. Let's see, what are those things? How do you capture your revenue? If you remember very well, under IFRS 15, revenue with contract, you don't recognize revenue until the money has been paid or the service has been rendered. So what are the basis for recognizing your revenue? Where are the evidence? What are the invoices? So the auditor will be testing for all of that. The same thing around purchases. The auditor wants to say, how do you make your purchases? At the purchases record, where is your purchase book? What are the accounting system for recognizing purchases? It wants to see the invoices for purchases. How are the entry done in the ledger? What are the suppliers' account? You want to obtain all the listing of the purchase, check whether they agree. The auditor wants to check for arithmetic accuracy. Oh, you said supplier supply you 1,000 units. Where are the books? Where are the invoice? Where are the POs for those purchases? So these are the things the auditor wants to test around when it comes to income statement. The same thing for your expenses, your costs. The auditor wants to see what are the justification for this cost. If you take for instance, payroll, the reason why payroll is also important is that there could be ghost workers. So money are not being paid to people who are not in the business. So the auditor wants to see the complete list of all your staff, want to verify their existence. That's also an assertion. Wants to verify the calculation and wants to check analytical procedure. Oh, you said you have this payroll amount this year or this month, and now it has increased. Have you recruited new people? Have the appropriate deduction been made for payroll and all of that? So the auditor wants to check for all of this. So basically, when you look at substantive procedure as a whole, one thing I want you to take at the back of your mind is that the auditor is testing for possible material misstatement. So that means the risk of errors, omissions, or fraud in the financial statement assertions. And when I say financial statement assertion, the basis of preparation of the figures in the financial statement, the assets, the liabilities, the equity, even the income statement. So substantive procedure is basically that. And when you are picking any line item, any group of item on the financial statement, be it asset, be it liability, equity, you must understand what it's testing for. The first thing is to understand what are the risk of misstatement associated with this and with this line item. Is it inventory? Is it the risk of overstating? Is it liability, the risk of understating payable? Is it equity? What are those documentations that back the equity? For non-current asset, what are the loans agreement? Is it in line with what the loan is supposed to be used for? So basically, these are the whole idea of substantive procedure. As much as this text material is direct, I want you guys to also go back, check past questions. I'll try and find past questions to bring next week so that we look at past questions that speaks to this. Now, before we close the class today, I want you to remember the assignment. I'll be dropping it on the group. Read about financial statement assertions. What are they? And how are they tested for? What areas should they be? How do auditors or how do auditors test for financial statement? What do we even mean when we say financial statement assertion? That's the first assignment. Then the second one is that you should read about contingent liability. These are more like your FR questions. But one thing about audit is that most times students don't know that your FR is very, very important in understanding audit. And that's why if you take past questions of audit, you will see the examiner asking some FR questions. So I want you guys to go back, read about contingent liability, read about contingent asset, and tell the difference between the two. tell the difference between the two, and the substantive procedure that auditors carry out to test for the two. So these are the two assignments that we'll be looking at when next I come, and we'll look at past questions. Any questions so far? Any question? Are we still there, or I'm talking to myself?
Yeah, yes, sir.
Okay.
Yeah,
And
yeah.
that's one thing about this online class. Don't worry. I will meet you guys physically in professional. You all pass and we'll see each other face to face, because I
Okay.
like my class to be interactive. Anyway, I hope you get the assignment.
Yes,
Yes,
sir.
sir. Yes, sir.
Okay. Okay. So please, and be reading. Oh, the exam is how many days now? Today is March 19. We have less than 2 months to go. Please, this is the time to buckle up. If you are doing 4 papers, 5 papers, please, there is no time for play. Okay? And I want to stop the class on site so that you guys can have time to read. Okay, this is where we'll